Okay, Rick, thanks for joining us for this quarter's update.
Rob, my pleasure as always. Thank you.
So there's been a fair bit happening in the world. As a manager of international equities, what's your thoughts on things that you're thinking about front and center?
Well, Rob, you're right. It's never boring. And the Trump administration, keeps us on our toes. But look, we're actually got a very constructive and optimistic view on equities at this point, looking forward. And it's all based on the fundamentals. Happy to sort of go into this in more detail, but there's a lot of press about the market being expensive and this being another dot-com like bubble. We disagree with that. I have got enough miles on the clock to have invested or to have been basically doing this during the dot-com bubble in the early 2000s, and I remember in those times, analysts were basically valuing stocks on revenue multiples, on potential price to earnings. Companies were presenting nothing more than business plans and being rewarded for it. There was really nothing fundamental about it. Look, we have a different view about that at the moment, in the sense that we believe that the AI bubble, as it's being sort of talked about at the moment, really isn't a bubble. And look, we're not that deep into that theme also. So, with physical AI, robotics really, is just sort of starting to come to the fore now. Artificial intelligence models like that, they're sort of being heavily invested in. That's also a concern with the market at the moment. There's been a lot of cross investment again with the companies that are basically in the AI space. But really, getting back to our key philosophy, which is earnings, and earnings drive share prices. The S&P 500 at the moment is trading around 22 times and change. So look, it's a little bit expensive versus its long-term average of around 21 or just under 21. But in saying that, when you strip out the AI stocks, and also you have to appreciate that these are getting larger and larger in a relative sense, so their weight is basically skewing the average multiples higher. If you strip it out, if you look at the S&P 500 on an equal weighted basis, the multiple is only 16.7 times.
Yeah.
Also, what we're pleased about is that the performance in the index is also broadening. It's not just AI related stocks. In fact, AI has sort of dragged recently, but the market has continued to move forward. And you just compare that to the local markets, and the ASX 200 is trading on 18.9 times. So that's not particularly cheap versus historical context also. But just to sort of labor the point a little bit more, the S&P 500 currently 22 times forward earnings. Over the next 2 years to 2027, has EPS growth of 29% forecast. The ASX 200 is 17%. So basically, certainly doesn't have the growth. And also, one thing that's giving us a lot of comfort is that the bottom up EPS growth estimates are materially higher than what we're seeing from the top down. So we believe there's going to be a lot of positive earnings surprise, which is going to continue to drive the markets higher. Really, we're in a bull market that's basically entering into a period of monetary easing in the US. It's all very supportive. So when you strip out stocks like Tesla, which are trading on 174 times financial 26 PER, Nvidia 29 times, Apple 30 times, and Meta 25 times, and we don't own any of these. The index is basically not quite as expensive as what the market's saying, and it's fundamentally backed. Again, versus a lot of the media that you read, that is very much like another dot-com bubble, which we don't believe it is.
Yeah. Well, I guess ultimately, time will tell, won't it? Like it always does when it comes to these sorts of things. Now, obviously, just sort of talking about how the market, given those 7 or 8 stocks, they're worth about 40% of the S&P, yeah?
Maybe not quite so much. I think the largest two, Apple and Nvidia, are I think about 4 or 5% each. So this is. Oh no, sorry, I'm thinking about the MSCI. You're right. Sorry. Yep. Yes, they are a large. Sorry, I'm thinking of different index. Yes, so exactly.
So the fact that, if someone's sort of passively invested in, say, an index fund, they're going to have 40% in those sorts of companies. But as you've sort of put it out, that you're not in them, and there's plenty of opportunity outside of those big names to be able to find reasonable valuations, and companies that have got good long-term prospects.
Yeah, yeah, definitely, definitely. So obviously, I mean, we're talking about the the S&P 500 in isolation, but yes, certainly. I mean, you are investing in those index by virtue of their size, not their fundamental value. And that is a real fear. Even with the index that we look at, which is the MSCI World or Net World. Yeah, look, those two stocks in isolation are 10% of the index. So they certainly have a fair weight. So yeah, as I said, this is why we believe active is the way to go. And look, they're great stocks. Don't get me wrong. They're just not cheap.
No, no, they're not cheap. Now, you also touched on the state of the Australian market, and I guess Australian investors for a long time have had a bias to owning local shares. They get the franking credits, et cetera, et cetera. But, as an investor, why is it prudent to be going offshore, given the nature of, I guess, our market relative to what we can get offshore, outside of the usual, the benefits, the franking credits, the no need to worry about foreign exchange, all those sorts of things. What are the things that you think should be, top of people's minds when they're thinking about, sort of allocating some money offshore?
Sure. No, that's a great question, Rob. Look, I think firstly, just to put into context, the Australian market is about 2.7% of the world's listed equity market. So when you're looking for the best opportunities to invest in, I mean, people with an Australian-only mandate are really restricting themselves to a very small pool. Then also, look, the equity market is effectively a barometer of the economic outlook. We believe that the outlook in the US relative to Australia is a lot rosier. Effectively, our fortunes here are very much tied to those in China. China at the moment is going through some very tough times. Their property sector is, well, basically waning or flagging. I think, property prices have fallen around 20% there with respect to like a chronic overbuild. And look, at one stage, urbanization in China was a great investment theme, but like any investment theme, things mature. And, China at the moment, I believe, is around 67% urbanized, which is pretty much at a level that's sustainable longer term. And essentially that then raises questions about the call for our key exports, being iron ore and coal, moving forward, where the property sector is basically in real strife, and China is basically facing deflationary forces as we speak. Further to that as well, you've got a banking index which we believe is ridiculously expensive, and they don't have a lot of arrows in the quiver. I mean, JP Morgan just reported a better than expected result, and is all largely driven by investment management, investment banking. The likes of Combank don't have that. They're basically savings and deposits. So, and you're paying a lot for that, and effectively, also for an asset class that's potentially exposed to an asset bubble, with respect to the price of Australian housing at the moment, which obviously is for another time. But Australian housing isn't cheap. On top of that, also, you've got a cost of living crisis and the ability for that housing sector to grow, and obviously what that means for credit growth at the banks. So, look, as I said, it's very much an relative outlook on the economies. Also, we've got a government which I believe is fiscally inept, where essentially, we've got decades of deficits basically forecast, moving forward, which isn't positive. And structurally, I believe, on the outlook of that versus the US, that the Australian dollar is overvalued and will have to basically rebase. And look, within the US, a lot of people have basically, criticized Trump's policies. We're a supporter of Trump. We think that the US would be in a far worse position if Harris won the election. But look, effectively, Trump with the tariffs tariff policies. They're generating income. They're going to help reduce the budget from around 7% to around 4%. The tariff revenue is running currently, or receipts from tariff revenues are currently running about the $500 or $600 billion rate at the moment. It's going to basically help fund the fiscal stimulus programs from the big beautiful bill. And also, look, the U.S. economy remains resilient in all of this. Inflation has not run away. Obviously, tariff pressures have basically been a one-off impost to inflation, as we sort of spoken about before and written in our note. But it's not the end of the world. Essentially, it also is now allowing the Fed to basically embark on an easing cycle. And they actually cut rates for the first time last month, and we see sort of more rate cuts coming. So all of that, we basically think in both an absolute and relative context, sets up an investment offshore versus, well, in the US in particular, versus Australia, on a very favorable note. I think that Australia's got some real challenges, because especially with resources and banking, which I sort of spoke to, that's over 50% or roughly 50% of the Australian index. And then, generally, as I said, the cost of living crisis here is real. Our energy costs are real. Our wages are too high. We don't have a manufacturing sector. And we essentially have a government that cannot stop spending. So you put all of those things together, in my humble opinion, it's very hard to get excited about the outlook of for Australia here. And just as an advertisement for our product, I mean, if you're an Australian citizen and you have an Australian income and you've got a house in Australia, it's probably not a bad idea to sort of diversify your investments and get some of the money out of Australia into markets and economies which we believe have a stronger outlook than what we do domestically.
Yeah, well, I don't disagree with your sort of take regarding the Australian economy and the obviously the issues that we have here. I guess I would probably say, to push back a bit, I think we're probably being a very bit rosy on the US. The US isn't without its issues. It's got a lot of debt, and we've got the debasement trade now apparently running around, according to CNN, or CNBC, or whoever it is.
Yep. No, look, obviously, and that leads to the discussion of the gold price. Look, firstly, don't get me wrong. I'm not saying the outlook in the US is headed feel right at a 45-degree angle, but at least issues in America are being addressed, and things are heading in the right way. We're not addressing anything here. The only thing that we're basically looking at is just the only thing this government is doing here is looking at ways to tax us further. So again, I think if you I was talking very broadly. Don't get me wrong. Yes, America has a lot of debt. But our debt's going to go up. Their debt's going to come back. So yeah, look, obviously the gold price has had like a 50% rally year to date. The last 10 weeks in particular have been stellar for the gold price. There's been a lot of talk on gold. Firstly, it's run because it's a hedge against the AI bubble. Look, we spoke about that before. And also, when you just look at that argument, I mean, gold has delinked from the VIX and put call ratios. I mean, the market, the volatility in the market has actually been incredibly low. So, to say gold is, has been a hedge against, volatility, or a dire sort of economic outlook, or, a pending meltdown in the market, it appears not to be the case. And just to sort of put that all in context, sorry about that, I should have done this first, is that the gold price has generally historically been negative correlated to equity markets. So it's a safe haven trade largely. So to see both, the equity markets and gold price being bouncing off of record highs simultaneously is something really quite strange. So as I said, gold is basically delinked from its historic relationship with respect to the equity markets. And so look, we spoke about a hedge against the AI bubble. I don't think that's a valid argument. Inflation, well, look, the argument with gold and inflation has been tenuous pretty much over the long term anyway, Rob, and it very much happens at both poles, either with deflation or hyperinflation. But again, when you look at the 1-year US dollar inflation swap, it's been pretty well flat since April, around 3.2%. So I don't think inflationary forces have really been driving the gold price. And as you mentioned, it seems to be all about debasement of the greenback. it's, a protest trade against the Trump policies, against, Trump's, Trump policies, the budget, the U.S. budget, and the U.S. debt. So look, you sort of spoke about our view. We believe that that the market will be experiencing a tailwind. The fundamental support is there. It's not ridiculously cheap, but it's not as expensive as people are saying. We're going to have a big meltdown. Sure, with the bull market that we've had, if we get a 5 or 10%, consolidation or pullback, that's not a surprise. But we're not heading into an environment of a meltdown. As we mentioned, we think that the Trump policies with respect to the budgeting, the tariff revenues, sort of reducing the budget deficit and helping to address the debt outlook, will be positively viewed. And realistically, we just can't see another alternative for the greenback as a reserve currency. So, there's been the rise of crypto and the rise of gold as a potential replacement of the US dollar as a key reserve currency. We just can't see that happening. So, gold is basically also being supported by the outlook of falling interest rates in the US now, and saying that it's already priced a lot of that in, given that it rallied sort of before rates fell. So realistically, if I had to name something that was a bubble in the market at the moment, with respect to our economic outlook, I think gold is more of a bubble than the equity market, and crypto as well. So our views a little bit different to consensus, but just being true to what our outlook is, we believe that the gold price has had a stellar run, but for reasons that aren't sustainable.
Well, as we sort of discussed before we jumped on, that's what makes markets, different opinions.
Look, as I said, you've got to have a position, and that's our position. And look, to date, we're very happy with the way things have gone. Our performance for the month. If you'd be kind enough for me to just mention that, and look, I'll share a slide. But again, September was a strong month for us. Up 3% versus the market, or as we defined it, the MSCI World Index up 2%. Over a rolling 1 year period, the portfolio is up 27.8% versus the market 22.5%. And since inception, we're running at 17.2% per annum compounding versus the market 15.5%. So we're very happy with those results. The portfolio continues to perform well, and as I mentioned before, we've delivered this performance without being invested in the very high PE stocks like Tesla, Nvidia, Apple, etc. And look, we've spoken about some of the opportunities that we've been invested in. We spoke about Alphabet, which last month, and they're just stellar stocks. Taiwan Semiconductor Manufacturing Company, again, a great stock, and not trading anywhere near those multiples with very, very strong outlook. So they're great stocks to be had, great investments to be had. And as I mentioned, these aren't available, to investors just in the Australian market, which is actually, if you're trying to fish for you're trying to fish for a large fish in a small pond. With what we do, we really just look for the best in, equity market opportunities, globally that there are. I should say globally on developed markets, 27 developed exchanges. So we believe that's why we should be considered in people's portfolios.
Well, Ric, congratulations to your continued successful long-term performance. It's been outstanding, as reflected by the fact that you're beating the benchmark in all time periods.
Thanks very much, Rob.
And that's not easy to do. Most fund managers don't do that. So, congratulations.
Well, look, that's kind. Look, obviously, the old saying is that past performance is an indicator of future performance. But look, at the moment, we're very happy with the way things have been going. We're coming up to 7-year numbers. So I think at the end of January, we'll have 7-year numbers. So we've been around for a while. And look, I think we can say with hand on our heart that our approach works. And look, we just continue to be very thankful and appreciative of the support of Shartru and the dealer group, with respect to sort of investing in our product. We really do appreciate it.
No problems, Ric. Mate, thank you very much for joining us, and we'll catch up with you next quarter.
Lovely, Rob. I look forward to it. A pleasure as always.
Thanks, Ric.
Thanks, Rob. Bye.